I think the performance is still coming from the same place. The bank continues to evolve, continues to transform. We continue to streamline, simplify, invest, and that is what allows us to beat expectation again and again, because this factor is not fully factored in, neither from us nor from the market as we look at our results.
See that loan loss provisions have increased to 300 million from 135 in the previous quarter. Shall we see there a sign of pessimism of what's coming next?
No, absolutely not. I think in the fourth quarter, we usually try to be as cautious as possible. As you saw, we took a lot of integration costs, which are building our lines of defense as we go into 24, 25, and 26. On provision is the same thing. I would look at it as our provisions are 12 basis points, which is substantially lower than the color that we have said we would be in, 20 to 25 through the cycle. And actually, they are very encouraging for us.
So for 24, there is more uncertainty. Some say we probably have reached NII peak, also more economic uncertainty, more geopolitical uncertainty. So what's the scenario that you're looking at, and how is that playing for your business?
So I do think that if you look at 21, 22, 23, we've had changing scenarios, uncertain scenarios, geopolitics, wars, and this bank has adapted every time. But one other thing that we have done, besides transforming, was to build line of defense. If you look at the results of this year, yes, we have reached 8.6 billion net profit and the profitability, depending how you read it, normal underlying profitability above 20%. Otherwise, 16.6, that's very good. But we have absorbed 1.1 billion in integration cost. We have further strengthened, as you said before, our loan loss provisions. So as we go into 24, we will continue to adapt. But what we will have is these lines of defense, which allow us to give a relatively positive, optimistic guidance of remaining broadly in line of what we achieved this year.
Ask you about your payout policy, of course. It's been an extraordinary run on the UniCredit shares, a really big boost there. So it will reach 100% of net profit this year. So it will be around 90% next year. Is that sustainable?
So firstly, we look at it a little bit differently. We think that what drives distribution is not net profit, but it's actually organic capital generation. What does it mean in practice? Over the year, through profitability and other actions, we build capital. And at the end of the year, we distribute it. So in our case, our organic capital generation this year is 12 billion. We said we would distribute 100% on net profit at 8.6 billion. While we're doing that, we're building 100 basis points of capital and bringing our capital from 14.9 to 15.9. I don't think many peers have that. As you go into 2024 and beyond, what we're saying is that we think that during this period, we will be able to continue distributing in excess of or equal in excess of 90%. So don't take 90% literally of net profit, because our organic capital generation is staying above our net profit. And so we will do so not denting capital, not using our excess capital in doing that.
Can I ask you also about your targets, the guidance that you get for 24? So net profit and net revenue kind of in line with what we've had this year. Are you being a bit conservative?
Well, it depends how you look at it. We just beat expectation on net profit by, depending which consensus you take, 800 or 900 million. And if you look at the consensus for next year or for 2024, by staying broadly in line, we would be beating consensus by more than 1 billion. So I don't think that that's conservative, particularly given that you see headwinds coming on the rate cycle. You see a number of things which we will be able to compensate through the lines of defense and the transformation.
Given the inflation picture that we've seen is starting to come through, when do you expect the ECB to start changing its moves on rates?
Well, I think the market now thinks that they will start coming down mid-year, so around June. And then the question is at which speed. There is now second thoughts, given that when you look at the US, it feels like rates will remain higher for longer. Will that apply to Europe? It's difficult to say at this point, but certainly I think everyone expects the decline in rate to occur in the second part of the year, not in the first.